Brad Williams, Frugal Finance. Here we go. We're going to get into the meat and potatoes of the next 140 sessions, if that's what you want to look at. We're going to get into forward-looking stuff. I'm going to take this slow. I'm going to try to explain it the best I can. Forward and future prices for foreign exchange. The distinction between forward and future prices emerges from the daily settlement features of future contract. We're not into futures yet, but we're working our way there. So consider forward and future contracts on foreign exchange that have the same expiration. Both the futures and the forward will have the same profit in the end, exclusive of interest earned on the resettlement payments. If the futures position is likely to have more favorable interim cash flows due to its positive correlation with interest rates, the futures price should exceed the forward price. By the same token, if the futures price is negatively correlated with interest rates, then the futures price should be lower than the forward price. This conclusion follows because the futures trader will then tend to experience losses just as interest rates rise. Finally, if the price of a commodity is uncorrelated with interest rates, then the forward and future prices should be equal. Notice that all of these conclusions arise strictly from economic reasoning and hold if investors are risk neutral. This is basic conversation on a trading floor. This is a basic conversation. When you're trading currencies, this is basic stuff. But for those not in finance, you either just turn this off, but don't. Or it's so foreign to you, you literally have to open up a dictionary. That's fine. We have correlation. We have forward rates. We have future rates. We have the foreign exchanges, and the previous three examples was probably all vague. But that's fine. We take one step at a time. Perhaps you'll get a better understanding within the next 6 or 7 sessions. While futures and forward prices differ in theory, the magnitude and practical significance of that difference is empirical. In general, studies of this issue find very little difference between foreign exchange forward and future prices. As one study revealed, foreign exchange information revealed that mean differences between forward and future prices are insignificantly different from zero, both economic and statistical sense. In view of these findings, results based on research in the forward market were regarded as holding for the futures as well. That's some academia stuff. I don't want to dwell too much on this. What we're going to do is look at some numbers. Earlier, we noted the geographic or cross-rate arbitrage opportunities that occur when foreign exchange rates are improperly aligned among single contracts. The arbitrage example of tables 4.1 and 4.2 arose from pricing discrepancies. Let's look at geographic arbitrage. Let's say you can buy €1 in New York 90 days forward for $1.25. You can sell €1 in Frankfurt 90 days forward for $1.35. You deliver the $1 euro in Frankfurt, collect $1.35. You pay $1.25 in New York and collect €1. You do this conversion, $1.33 over to $1.25, and you make 8 cents. Okay. Brad Williams, Frugal Finance.